being animated. They are also going to publish their global hydrogen review. We have sent you the link to the publication, so you have the latest developments in policy, infrastructure, trade, investment, and innovation. So I leave the floor without further ado to Jose Bermudez, who's going to present today's session. Thank you, Jose.
Thank you very much, Tawana, and good morning, evening, afternoon for everyone. Really glad to be here and to have the opportunity to present you with the work that we are doing on hydrogen and try to give you an overview of everything that we are tracking and following on the hydrogen sector. So let me start by, as usual, sharing my screen so you can see the slides that I'm going to be using. And if things are working well, I think that you can see it now. If Elodie, maybe you can just give me a thumbs up if everything is okay.
It works. Perfect.
Okay, fantastic. Thank you very much. So, well, just as an introduction, my name is Jose Bermudez. I am the person that coordinates the work that the IEA does on hydrogen. And that, of course, includes, as Tawana mentioned, our Global Hydrogen Review, which I will also introduce during this presentation. So, just to start, this is kind of the content of the topics that I'm going to present today before the Q&A session. I will start with a short introduction to hydrogen basics, what is hydrogen, how we use it, how we produce it, and so on. And to then provide a snapshot of what is today the status of the hydrogen sector. Then I will jump into the evolution of announced hydrogen projects or projects for the production of what we call low emissions hydrogen and the cost of produce it, which is one of the main barriers today. Then I will continue some discussion about demand and the challenge to stimulate demand for low emissions hydrogen. We will touch a bit on the topic of trade and infrastructure and the role of ports in facilitated trade and infrastructure development. I will show some key findings about the opportunities and challenges for emerging and developing economies to turn the announced hydrogen ambitions into deployment. And I will finish with a short overview of policy developments in this last year, and will give you some information also about past years. And just finish with the recommendations that we are giving for governments, from private sector, for everyone to make sure that they can tap into opportunity that hydrogen offers to meet their energy goals. But as I mentioned, we have this report, the Global Hydrogen Review. Practically everything that I'm going to tell you today is coming from the latest Global Hydrogen Review. This is an annual revision that the IEA publishes about the status of the hydrogen sector. We started back in 2021, so we have had 5 editions. And the request of our member governments and also the Clean Ministerial Hydrogen Initiative to have this annual tracking of what is happening in the hydrogen sector. It's a report that has a very complete data set and analysis across all the value chain of hydrogen, from production to demand, things about infrastructure development, trade, things on investments. Investment is not one of the biggest topics of the report, but there's some information there. I'm pretty sure on this forum will be quite interested on that part specifically, but also innovation, policy. And we also have every year some ad hoc analysis, which is not part of the regular tagging of the report, but are special focuses on specific regions. We have had one on energy security, on demand creation, on the greenhouse gas emissions across the value chain. So every year we try to bring a new focus with additional analysis that can be useful for the community. We will share the slides with you after the presentation, and you have the link so you can access the last one. And if you want to access the other ones for the different special focus, as simple as changing the year at the end of the URL. So with that, let's focus on the nitty-gritty of the presentation and the real content, starting with some hydrogen basics, about what is hydrogen and its value chain, basically. Hydrogen is today currently mostly used in industry as an industrial feedstock to produce other products, fertilizers, explosives, methanol, other chemical products, oil refining, many things. But it has also the potential to become a very flexible energy carrier or fuel, no? And this versatility comes from the different ways in which it can be produced, it can be used, converted into other fuels, or transported. No, so starting with the production, and I have put in this slide, like a schematic of what could be the hydrogen supply chain. Starting with this production, we have to keep in mind that although hydrogen is the most common element in the universe, in the Earth is almost always found combined with other elements. So we need to separate it from those elements, no? And there are several ways that we can do this. One is producing it from fossil fuels, which is the traditional route, from natural gas, from coal, without using carbon capture, or we can do it with capturing the CO2 emissions produced to reduce those emissions, no? We can do it by using electricity in devices called electrolyzers, and then split their water into hydrogen and oxygen. We can extract it from biomass, so from biomass waste, so biomass, sustainable biomass. And very lately, we have also find out that we can explore ways to recover some naturally occurring hydrogen that can be found underground. But I'm not going to discuss about this route today because it's very early stages of development. Hydrogen, as I mentioned, it can also be a very adaptable fuel. It can power applications in practically every part of the energy system, no? Including industry, transport, oil refining, can be used to produce other fuels such as ammonia, methanol, methane, synthetic kerosene, synthetic diesel, many different things. And it could also even be used for heating buildings, but I'm not going to speak about that because there are only some uses in which it really makes sense to use hydrogen from the economic perspective, from the efficiency perspective, no? And later we will talk a bit more about those more valuable applications. And also today, hydrogen is mostly produced and used in the same site, in the same facilities. But when production are not co-located, there is a need to transport hydrogen. And there are several ways in which we can do that. We can compress it and move it through pipelines. We can cool it until producing liquid hydrogen and then shipped and then turn it back into gas at its destination. Or we can transform it into other chemicals, and we can think about ammonia, methanol, synthetic fuels through Fischer-Tropsch processes, methane, which are easier to transport, no? So hydrogen can be transformed into these products and be either shipped or transported in pipelines in other transport means. And then at the end being used as these products itself or be converted back into hydrogen. So as you can see, hydrogen is very, very, very flexible, but this can also be an opportunity or a challenge, no? Because there are so many ways in which we can make it, move it, and use it, that building efficient supply chains requires very careful planning, and sometimes this is complex from the investment point of view. Then once we have explained the supply chain, let's focus on what's the status, no, or of hydrogen today, yeah? Because despite this versatility that I have just mentioned, hydrogen supply chains are today quite concentrated in some production technologies and demand sector. In the slide, you can see a snapshot of the current state of hydrogen production and use. Demand is largely concentrated. Basically, is used as feedstock in industry, especially in ammonia and methanol production, also in some steel manufacturing, and also mostly as a feedstock for oil refining. And also geographically, the production of hydrogen, demand for hydrogen is very concentrated, no? China alone accounts for around 1/4 of demand, and production as well, as I mentioned, today is very collocated. And China, North America, and the Middle East together account for around 60% of global production and use. In 2024, hydrogen demand reached nearly 100 million tons, which represents a 2% increase against the demand from 2023. And this continues a growth trend that we have observed over several decades. However, this trend has nothing to do with any kind of policy efforts, either to decarbonize the system, fight climate change, improve energy security. This is just driven by global industry trends and trends of those products that require hydrogen for their production. No? And in addition, it has no benefits in terms of reducing CO2 emissions because practically all hydrogen production today is based on unabated fossil fuels. Currently, low emissions hydrogen, which or what we at the IEA we call low emissions hydrogen, which is either produced through the use of renewable or nuclear electricity in electrolyzers, the use of sustainable biomass, or the use of fossil fuels with carbon capture storage. This accounts for less than 1% of global production. However, this status of today is likely to change in the future, no? As countries move forward with their plans for decarbonization, for improving energy security, for enhancing industrial competitiveness. Hydrogen must play an important role in all these aspects, no? So if we just take into account the policies that are already implemented, which is what is represented in the IEA stated policy scenario or steps, as you can see in the slide, by 2030, we estimate that hydrogen demand could grow to more than 150 million tons, and its use starts expanding into new sectors, particularly those that are hard to decarbonize, no? And we can think about heavy industry, the maritime sector, aviation, in these cases, either in form of hydrogen or hydrogen-derived fuels, long distance transport, but also electricity generation, no? To integrate more renewables and provide long-term energy storage. But in addition, the way in which hydrogen is produced, it also expected to change significantly, no? And again, in this scenario, we see a penetration of low emissions technologies, which can account for around a quarter of the global hydrogen production. No? But then if we think about a more aggressive scenario in terms of the energy transition, the decarbonization of the system, like our net zero emissions by 2050 scenario, which is the one that you can see as NZE in the slide, we can see that hydrogen demand could grow by a factor of 4 by 2030, no? And the penetration in these new applications that I mentioned, heavy duty transport, aviation, shipping, the production of other hydrogen-derived fuels, it's much more significant, no? But also the production changes massively, no? And in this scenario, we see that 90% of hydrogen comes from those low emissions routes that I mentioned. So this illustrates the direction in which we need to head in, but where we are and where we are actually heading, this is what the question that we try to respond annually with this Global Hydrogen Review. Now, let's recap a bit of the status of the sector today. As I mentioned, this report, the Global Hydrogen Review, has 5 years. But at the time that we released the first edition, the Global Hydrogen Review in 2021, the hydrogen sector had gained a lot of momentum. No? There was a wave of very ambitious government announcements for the adoption of low emissions hydrogen that received a similar vigorous response from the private sector, with hundreds of announcements for projects for the production of low emissions hydrogen. But now, 4 years later, what we are seeing in the news are negative headlines about project delays, cancellations, downward revisions of those commitments for the adoption of low emissions hydrogen. But while the challenges that the hydrogen sector that we are going to see across the presentation are leading to a slower development than the one that we expected back in 2021, when we take a closer look to data, rather than a sector that is stalling or faltering, what we see is a sector that is progressing and is reaching important milestones. And let me give you some examples. Back in 21, again, citing this first edition of the Global Hydrogen Review, there were only a handful of small projects for the production of low emissions hydrogen operation. Since then, productions have grown by 60% and is on track to reach 1 million tons for the first time this year. And then looking to 2030 and based only on projects that are in operation, under construction, or have taken a final investment decision, low emissions hydrogen production is set to surpass 4 million tons. This, of course, is much lower than government ambitions at the beginning of the decade, government and industry ambitions. But it still represents a growth from less than 1% of total hydrogen production to 4% by 2030. And this would put low emissions hydrogen growth on par with the fast expansions that we have seen for other clean technologies since in recent years, such as solar PV. Projects are also becoming larger. Again, in 2021, the largest electrolyzer project in operation had a capacity of 30 megawatts. Early this year, a 500 megawatts electrolyzer has been commissioned in China, and the largest electrolyzer project under construction in the world, which is the NEOM Green Hydrogen project in Saudi Arabia, has expected capacity of more than 2 gigawatts. And finally, another area where we see a lot of progress is in technology developments. No? There are plenty of technologies that are moving from small prototypes to demonstration to commercialization. And this is particularly important on the demand side, as we can see here in the slide with steel and shipping. There are several technologies that we think that could reach commercialization before 2030 on the demand side, which could help unlocking large demands for low emissions hydrogen. Now, despite this progress, the sector is entering a phase of consolidation. While in the past year we have seen a continuous growth in the potential low emissions hydrogen production from announced projects, that's what we have been seeing in the different reports. So on that potential in production that could reach by 2030, this year, this potential production has declined for the first time due to projects being cancelled or particularly postponed post-2030. This potential production fell particularly in electrolysis projects, which they were responsible for 80% of this decline. Also, looking at the status of the projects, the drop is mainly coming from projects that are at early stages of development. When assumptions on potential cost reductions have been too ambitious or expectations for future market developments have been too optimistic. So when we take a look to the reasons that companies are giving for the reduction, the delay, or the suspension of the projects, they can be manifold, but there are 4 reasons that stand out. First is regulatory challenges, such unclear or complex definitions in the regulation on what is low emissions hydrogen and what could be eligible for public funding support, but also slow permitting procedures. I went far too fast. Okay. Another reason is the high cost on low emissions hydrogen in combination with uncertainty about the criteria to secure public funding, which this impacts, of course, the economic of the project and delay investment. The third one is technical and supply chain challenges. For example, some electrolyzer manufacturers are facing insolvency or are scaling back operations. This undermines the confidence on the supply chain and increases risk during project delivery, but also during project operations. And finally, many projects are struggling to secure credit-worthy offtake agreements. And this is a topic that we discuss in more detail later in the presentation. So, well, as I already mentioned, we have 4 million tons of low emissions hydrogen production expected by 2030, just based on projects that have at least final investment decision. But this represents only around 10% of the total project pipeline. 90% of the potential production of announced projects come from projects that are earlier stages of development or planning. So with that, with the decline that we have seen in the project pipeline this year, and also taking into account that we have only 5 more years until 2030, we have asked ourselves how many of these projects can still be realized by 2030. And to answer this question, we have assessed project by project the likelihood of these projects to be in operation by 2030, taking into account factors such as the project status, its size, the target hydrogen use, the location of the project, factoring aspects like finance cost, existing energy infrastructure in a given country. And based on this assessment, we think that there are additional 6 million tons of low emissions hydrogen production, which has a strong potential to be operational by 2030, as long as government support is available to close the cost gap with hydrogen produced from unabated fossil fuels, which I will discuss later, but also policies to stimulate demand, particularly in existing industrial applications. At the other end of the spectrum, we have around half of the total production in the pipeline, with the pipeline, which has low potential or is certain to be in operation by 2030. Around half of those projects are very large electrolysis projects in emerging and developing economies, which have low-cost renewable resources, but lack infrastructure, has problems to secure offtake agreements, and has important financing challenges. Then jumping into this topic that I mentioned, now the cost of low emissions hydrogen and the gap with unabated fossil-based production, this remains actually as the main barrier for adoption. In addition, in the last couple of years, for example, renewable hydrogen production costs have been going up rather down. And this is a result of a mix of inflation, but also cost estimates becoming more realistic as projects progress to more advanced stages. But also that we have had a slower than expected development. We expected to have more development that could have pushed down the cost of these technologies. So this results in a situation in which today there is still a cost gap between renewable hydrogen and hydrogen that can be produced with fossil-based routes. But this gap differs across regions. No? For example, in China, this gap is relatively small, thanks to lower electricity prices, lower cost of capital, but also economies of scale and experience with large construction projects, which enable low cost for balance of plants for the electrolyzer, but also lower cost for engineering, procurement, construction, which altogether accounts for about 80 to 85% of the capex of a project. In China, the cheapest renewable hydrogen today is already at the same cost level that the most expensive hydrogen from fossil fuels with carbon capture. But by 2030, as renewable hydrogen becomes cheaper, this overlap is expected to increase, and the cheapest renewable hydrogen could even become competitive with hydrogen from unabated fossil-based production. But this only happens in China. No? If we think about other regions with cheap gas, it is much more difficult for renewable hydrogen to compete. Even though regions like the US or the Middle East have rich renewable resources, the high capital intensity of renewable hydrogen makes it much more difficult, make it much more expensive and difficult to compete with fossil-based routes. Although this gap is expected to decrease as well in the next few years, it's set to remain very large. And in terms of producing low emissions hydrogen production, CCUS is likely to be more competitive in the near term. And finally, we have a third type of regions in which there is a relatively high cost of natural gas and that are import dependent, no? And we can think about Europe or some Latin American countries. Also, these regions do not count with the technology cost and capital cost advantages of China. So the cost gap is still significant today. But again, it is expected to decrease by 2030 thanks to technology improvement, but also policies like carbon pricing. In the base locations for renewable hydrogen production in these regions, we think that this gap could be reduced to just above $0.50 by 2030. Sorry, $0.50 per kilogram by 2030. Speaking a bit more about this competitive advantage that we have mentioned about China, no? China is today driving the deployment and the manufacturing of electrolyzers. The country accounts today for two-thirds of global installed capacity, two-thirds of total capacity that has already reached final investment decision, but also nearly 60% of global electrolyzer manufacturing. And looking to 2030, and taking into account only committed projects, this image or this picture is not expected to change significantly. So this situation mirrors the remarkable success of China in solar PV or electric vehicles or batteries. So people have started to ask the question whether electrolyzer will follow the same trends as solar PV and batteries and electric vehicles, with China dominating the global market. So if we compare the cost of making and installing an electrolyzer, for example, in China and in Europe, the intermediate answer or the immediate answer will be, well, maybe yes. But the cost of installing a Chinese electrolyzer in China is indeed 60% lower than installing an European-made one in Europe. But the equipment costs are only a part of the total investment to install an electrolyzer. No? More than half of the cost corresponds to engineering, procurement, construction, contingency, which depend on the local conditions. When taking into account also tariffs and shipping costs of equipment and these local costs, the cost advantage of Chinese electrolyzer decrease. No? In the case of Europe, it shrinks to 20% compared to European manufactured electrolyzers. And the impact on the hydrogen production cost is even smaller. Electricity costs are still today a major component of the total cost of producing hydrogen. And Chinese electrolyzers today still suffer from lower efficiencies and performances compared with European, North American, Japanese electrolyzers. So in terms of the production cost, this cost advantage of Chinese electrolyzer is even lower. From our analysis, we have seen that this cost reduction that can be achieved varies between 5 and 15%. And there are certain project configurations in which the production using electrolyzers from manufacturing in China could even be higher than the Western competitive. But this does not mean that the situation will not change in the future, because Chinese electrolyzer manufacturers are already investing to address those efficiency and performance issues, and are also exploring overseas manufacturing to avoid challenges with supply chains, with post-selling services. Well, let's now focus or change the focus of the presentation to the topic of demand, which, as I already mentioned, is one of the key challenges for projects, for production projects to secure investment. A good indicator of the health of the sector in terms of demand is the signing of offtake agreements. The volume of new signed deals fell sharply in 2024 to around 1.7 million tons compared to 2.4 million tons that were signed in 2023. This decline mainly reflects fewer trade-oriented agreements, particularly those targeting international exports, but with an specified end use, which tend to be preliminary and non-binding. So this says that these are not so bad news, because a lot of the previous offtake agreements were very preliminary and non-binding. Then, in terms of geographical distribution, we see that on the demand side, most of these offtake agreements have taken place in Europe, which accounts for more than half of those agreements. But when we look at the distribution of the producers, we see a wider regional distribution. No, Europe is still on the lead with around a quarter of this production, but there are notable contributions from Canada, from the US, from Latin America, India, or the Middle East. Then, when we look at where these offtake agreements are happening in terms of the application, we see that offtake agreements remain concentrated in refining, in industry, and in the production of hydrogen-based fuels. Together, these agreements account for around 80%, 85% of total volumes and almost of the offtake agreements, of the firm offtake agreements. Another point on agreements is that in 2024 they were also weaker than in 2023. The firm contracts were only 20% compared to 30%. But there is a positive news on that some preliminary agreements from previous years have been converted into firm contracts in 2024. And this actually helped to unlock some investments on the production side. These investments on the production side have been growing over the last few years, but with a strong correlation with the sectors where we are seeing offtake agreements. No, the majority of those investments are happening in industry, in refining, and in hydrogen-based fuels productions. But of course, not all the FIDs are related to an offtake, since some projects are for self-consumption, no? And do not involve an offtake agreement with an external partner. But all these projects for self-consumption are either for refining or for industrial applications, no? So again, within those sectors, we are seeing most of the offtakes. This reinforces the idea that these sectors are readier for the adoption of low emissions hydrogen in the near term, and policy action in these existing uses and high value applications are the most effective ways to scale up demand in the short term. Another indicators that we are tracking are tech targets. No, several private actors have turned into procurement tenders to meet the targets for low emissions hydrogen use. No, in the last year, when we published Global Hydrogen Review 2024, we highlighted the launch of 6 initiatives in India and Europe that collectively targeted the procurement of around 1 million tons per year of low emissions hydrogen. 1 year later, we have tracked the progress on those initiatives to see the outcomes that they have achieved. And we have seen that the results reflect diverging outcomes across sectors, shaped by cost pressures, by pricing mechanisms, but also by infrastructure challenges. Looking at the sectoral breakdown, we can see that the launch targets, practically all of them targets 3 sectors. Refining, which accounts around half of these tender volumes, fertilizers, and steel. So practically all of them are for industrial application. Looking at the results, overall 35% of the tender volumes have already been awarded. Half of them are still open or under evaluation, and 14% have been paused. But progress differs significantly for each sector. No, in refining, we have 41% of the volumes have been already awarded, and 59% remain under evaluation. There's noteworthy progress in Europe, where Total Energies has signed contracts for 200 kilotons for hydrogen supply, and expect to finalize the contracts for another 300 kilotons, the total of the tender, by the end of next year. It's also worth to mention 3 smaller tenders in India, which have already been awarded, and one of them has actually led to a final investment decision in a production plant. In the fertilizer sector, although with some delay compared to the original plants, the Solar Energy Corporation of India has awarded all the tender volumes that they launched in 2024. And it has already signed contracts to supply ammonia, in this case, ammonia produced with renewable hydrogen, to 13 fertilizer plants. On the less positive side, we have the steel sector, where we have seen a slower progress, no? 50%, 57% of the tender volume remains open, and 40%, 43% has been paused, no? And this has been because the bid prices for the tenders are exceeding the acceptable thresholds on the sector, but also in this case there are delays for some of these potential users, delays in the development of hydrogen pipelines, which will not allow to get the low emissions hydrogen in time for the development of the projects. So continuing with demand, but now on the policy part, the implementation of demand policies will be needed to unlock the investments that are needed on the hydrogen supply side. No, I have already mentioned that we have 4 million tons of hydrogen, of potential low emissions hydrogen production already committed by 2030. And this level of commitment is slightly lower than the demand that we estimate that could be created by the policies that governments have fully implemented as of today, no? And there is still a small gap, but we think that is likely to be closed by new FIDs that are expected by 2030, in the next 2 to 3 years for production available by 2030. However, if we consider also those projects that have not yet committed investment but have a strong potential that I have already mentioned, we see that those aligned with the government targets for demand creation. No? So this highlights the importance of unlocking investments on these projects to meet government ambitions, but also that realizing these investments hinges itself on the implementation of policies for demand. There has been some initial efforts in places like in Europe, in Japan, in Korea, in India, on the IMO, but the implementation of these first efforts is still slow, no? And in addition, many of these efforts are not targeting the right applications. No, these policy efforts are distribution across all sectors. We have only around 50% of the demand that could be created through these policy efforts, which is targeting those existing uses or this adoption of hydrogen-based fuels in high value applications such as shipping or aviation. No, which as I explained before, is where we are seeing the investment. So they are the ones that are readier for large scale uptake in the short term. Let's switch now to other topic that has attracted a lot of attention, which is trade. No, we estimate that there are 16 million tons of low emissions hydrogen that could be traded by 2030 if all announced projects are realized, which accounts for 45% of all announced projects, showing that trade is a significant driver for project announcements. Despite the uncertainty on the creation of a global hydrogen market. A larger share of the announced projects are electrolytic hydrogen projects, no? More than CCUS projects, because the role of CCUS projects in trade is more uncertain due to the potential low uptake in markets that are expected to be high offtake markets such as Europe. Only 1 in 4 trade-oriented projects have identified a potential off-taker, no? And as I said, this is an important requirement for FIDs. Therefore, again, this suggests that the creation of a global market for hydrogen trade by 2030, at least, it remains very uncertain. So using the same methodology that I explained before about the likelihood of projects, we see that in addition to 0.8 million tons of trade-oriented projects that are already at least in FID, there is another 1 million tons that we think that has a strong potential to be traded within this time frame. But again, this requires support schemes to close the cost gap. It requires offtake to be secure. So again, demand policies on supply. But in this case, it also requires the development of infrastructure for the delivery of these products. However, 75% of the announced volume from trade-oriented projects in the pipeline has very low potential, or low potential is uncertain to be operational by 2030, and most of these volumes are in large-scale electrolysis projects in emerging economies. Then, when looking at the geographical distribution of these projects, we can see that in the export side, it's highly concentrated in the emerging economies. Most of low-emission hydrogen projects target, on the other side, exports to Europe, mainly to Germany and the Netherlands, and Japan or Korea. And then in terms of the carrier to be traded, we see that 85% of these trade-oriented projects are planning to transport hydrogen as ammonia, which account for almost 14 million tons out of the 16 million tons expected to be traded. No? And transforming into ammonia, this will be 75 million tons, which is a very significant volume when we take into account that today global ammonia production is around 200 million tons, and traded ammonia today is 20 million tons, so around a third of the expected traded ammonia by 2030, or the new trade ammonia by 2030. No? So all these points to the uncertainty of the development of this market. Well, we have already talked about production, demand, trade, but then the other important thing is infrastructure. No, there are around 37,000 kilometers of hydrogen pipeline that have been announced by 2030, but less than 6% have firm investments, mostly in Northern Europe and in China. And there has been very little progress in this year. So in the report this year, we have taken the opportunity to look closely to ports and the role that they can play in the adoption of low emissions hydrogen by supporting the decarbonization of the shipping sector, by aggregating demand, since most of the chemical plants and refineries are close to large hydrogen users today and are located near the ports. But also to the role that ports can play in enabling trade for low emissions hydrogen. So we have looked at where the low emissions hydrogen production has been announced and how close they are to main bunkering ports and high traffic ports today. And our analysis suggests that 70% of announced hydrogen production is located within 500 kilometers of those major port areas. Around 130 ports could access, each of them, 100,000 tons of low emission hydrogen production per year from announced projects that are nearby them. However, this distribution is uneven. A higher share of tanker and dry bulk ports are located to are close to where the low emission hydrogen projects volumes are located, no? Compared with container ports that have a lower share of their ports located close of these production projects. This can have implications for the adoption of hydrogen-based fuels, since container shipping has a higher value than dry bulk or tankers. And it means that it will be less sensitive to the potential premiums of these low emissions fuels. No? And another important thing is that the development of the infrastructure that is needed to facilitate this access to hydrogen-based fuels doesn't have to start from scratch. existing facilities and experience in handling other chemicals provide a strong foundation for the creation of this infrastructure. Today, there are around 140 terminals already operating around the world or under construction for methanol, and 108 terminals for ammonia. And there are also 300 terminals for LNG and roughly 1,000 terminals for LPG. No? This shows that ports already have extensive experience in handling chemicals and liquefied gases, which is important as low emissions hydrogen-based fuels can be more complex to handle than traditional fuels. These ports are likely to be better positions for early adoption of low emissions fuels, as they have already permitting processes, trained personnel, storage capacity available. No? So to assess the readiness of ports to adopt or to develop this kind of infrastructure, we have developed a chemical handling infrastructure score, which is inspired by similar initiatives by the shipping industry. We estimate that 80 ports have been able to score high on this index, no? And 55% are close to potential production of low emissions hydrogen. This suggests that these ports, which are located in the Middle East, in the Suez Canal, in the US coast, in Europe, could be more ready to the adoption of these fuels and to handle these hydrogen-based fuels. This does not mean that in the long term there are no other ports that could develop these facilities, as we have seen, for example, with the rollout of LNG, but it will be more challenging for them. Now, let's switch to a topic that I think will be interesting for you, which is the opportunity that low emissions hydrogen could provide to emerging and developing economies. Africa, Latin America, Southeast Asia, together they account for 35% of world's population, but only 16% of energy demand. And then in terms of hydrogen, they consume a similar level of hydrogen, all of them, between 3 and 4 million tons per year, each of them, which is around 11% combined of global hydrogen production. These regions have attracted a lot of attention from project developers, and together represent a quarter of total of the project announced today, around 9 million tons of potential production by 2030. But there are significant differences between these regions and the global picture. Nearly all announced projects focus on electrolysis, whereas in case of CCUS, they account for around a quarter of the global pipeline. Projects are also advancing more slowly. There's around 9% of projects around the world that have already a commitment investments, where this figure is only around 0.5 for emerging economies, which raises questions about the viability of the development of these projects in the near term. Almost 80% of announced projects in these regions are at high gigawatt scale or larger, compared to 60% global. And this creates significant challenges in terms of finance, but also the new renewable power capacity that must be deployed. And also 80% of the announced projects in these regions are geared toward exports, which is nearly double when we compare it to the global average. And as I mentioned before, this is very uncertain at this point to develop by 2030. So to unlock the full potential of low emissions hydrogen in emerging economies, we think that there is a need to shift the strategic focus with building strong foundations for expanding electricity access, lower the financing cost, which is one of the main challenges of the region, but also creating opportunities for domestic markets in things like fertilizers, for example, or exports of value-added products more than hydrogen itself. Developing financing institutions, of course, could play a key role in helping emerging economies to address these type of barriers that we have mentioned. They can provide support to the risk early stage projects, but also they can support beyond what is capital support, no? Including sector policy engagement, technical assistance, to build local capacities for both policymakers and domestic stakeholders, no? Developing financial institutions funding for low emissions hydrogen has rose sharply since 2022 and has reached, so it moved from nearly zero to 4.6 billion of committed investment, another more than 2 millions in announcements. No? But beyond what is sovereign leading, development finance institutions can also support the private sector with their private sector arms and also investments directly in projects. No? Since the publication of our report, for example, there have been already 2 projects that have announced that they are expecting to reach final investment decision either by the end of this year or early next year, and they have been supported by this type of institutions. No? One in Paraguay by the IDV Invest from the Inter-American Development Bank, and another one in Mexico with support from the International Finance Corporation of the World Bank. Finally, I want to just give you a brief update on policy, on what happened the last year. No? Last year there will be 30 billion of US dollars on public funds that have progress from announced to awarding. No? To put this in context, this is 10 times larger than the total investment that happened in 2024, but this is expected to be deployed in multi-year programs, so it's not only on a one go in 2024. And it combines CAPEX and OPEX supports through, although there are many incentives in the form of quotas, for example, that cannot be translated into funding. No, 90% of the funding came from advanced economies. This reflects the policy choices, like as I mentioned, programs for supporting CAPEX and OPEX, while the developing economies tend to use other type of incentives, such as tax incentives, reduce administrative procedures, land allocations, which cannot be explained in terms of specific funding. No. Then in terms of the parts of the supply chain, the supply side still receives more support. For every dollar that has been given to the demand side, we estimate that there has been $1.5 that has been given to the supply side. This is more balanced than in previous times, but it's still higher than what it will be desirable. Then the share of funding from policies that have been implemented is now almost 75% compared with previous year when it was much lower. No, we have seen many announced policies that have moved into implemented policies in the last year. And finally, again, in terms of the total value change, the demand side has represented 14 billions in the forms of contracts for difference, mostly in Europe, in Australia, but also in India. But we have also seen some progress in terms of the creation of hubs, which can pool many investment for demands, and this can also help in addressing challenge of coordination with different stakeholders. And just a quick final slide with our recommendations for governments, which have been quite the same across the 5 reports, but we have been trying to nail down then according to the progress that has been achieved in the sector. First of all, we need that it's very important to maintain support the schemes for low emissions hydrogen production. There are many projects that are ready to invest if timely support helps them to close the cost gap with unabated fossil-based hydrogen production. No? And this can enable rapid scale-up and cost reduction. There is also a need to accelerate demand creation, so it can facilitate offtake and underpin investments on the supply side. Key opportunities we have seen in that they are in existing uses, refinery, chemicals, but also it could be an opportunity of pulling demand in industrial hubs to create a scale up and reduce risks. Another thing that we have recommended this year is that governments and industry can cooperate in the creation of lead markets for sustainable end-use products, which can unlock early stage adoption. There is also a need to expedite hydrogen infrastructure development. Infrastructure projects often take more time than originally planned, which means that really clear regulations, financial tools, efficient permitting can help in cutting these delays and facilitate and deal with early investment risks. We have also put a recommendation this year about innovation because we think that it's important to support early stage hydrogen technologies with public finance instruments that can help in reduce risks. For example, export credit agencies, public finance institutions can provide warranties for first of a kind projects that seek to demonstrate and scale up novel technologies and don't have a strong track record on the demonstration of these technologies yet. And finally, there is a need to support emerging and developing economies in moving up the value chains. These countries, I have already mentioned, they have a strong potential for low cost and low emissions hydrogen production, but they face challenges in access to finance, in limited infrastructure, in their willingness to participate in a global market that is still not very developed, so can challenge offtake. So by partnering with advanced economies, and particularly by developing domestic use cases and opportunities for the exporting hydrogen-based products, high-value hydrogen end products, we think that is where these economies can tap into the opportunity that hydrogen offers to them. Finally, I would like to introduce you to a new online tool in addition to the report and that we have launched this year, along with the report, of course, and also along with other project databases that we publish and update every year. This tool that we have called the IEA Hydrogen Tracker is a new data source in which you could access all the information that is in the report, but much more. And it includes other information that we cannot provide in the form of the PDF. No? This tool includes a map of operational and announced projects for low-emission hydrogen production with information about their location, size, technology, and status. It also includes data on production of low-emission hydrogen and infrastructure, both historical and potential from announced projects, not only at global level, but also with a breakdown by region and country. It has detailed analysis on today's production cost and potential cost reductions by 2030 in different regions of the world. And finally, it has a policy dashboard with more than 1,000 hydrogen policy measures that has been announced or implemented worldwide since 2020, so not only for the last year. And they are classified by country, type of policy, status, and you have the possibility to access a detailed description of each of the policy. So I invite you to visit this tool because I hope it could be useful and you can find it helpful for your daily work on hydrogen topics. So this is all from my side. Thanks a lot for listening. I hope it has not been too long, too boring. And now, of course, I am more than open to any questions from the audience.
Thank you very much. Sorry, I have an echo. Thank you very much, Jose. No, not at all too long and not boring at all. Very helpful, very good to learn all these new trends and technologies advancements. I think it will be very useful for our members. So yeah, we have scheduled 1.5 hours to have this 1 hour presentation and leave this 30 minutes to all our members to exchange, to ask your questions. Also that for yourselves, but also for the club in general. And just to remind you that this is part of a partnership between IDFC and IEA, where IEA is supporting us through this capacity building to our members, both the in-person training session that we had in Paris earlier this year, also these online sessions, and also reinforcing the capacity of the club in general to make better investments into clean energies and the clean energy transition. So I leave the floor open to anyone who has any questions or comments on everything that has been said.
You can also write in the chat if you are too shy. No worries. And I think if you have experience working on a hydrogen project, it's also nice sharing your experience. Not just having a question, but just, yeah, commenting and launching a discussion.
Yes. We know there is a very niche segment that is very particular to each market and country and context. So we'll be very happy to hear from you all. And as I was mentioning at the beginning of the session, this is the last one from the year. So next Friday, the December 5, we'll have the last climate online session on climate, on grids, financing grids. It will be also animated by IEA. So we'll also see each other next week, next Friday. Yes, Christian, please.
Yes, thank you for the presentation. I would like to, in one part of the presentation, you mentioned that some technological breakthroughs were expected for the upcoming years. I would like to understand a little bit better in what specific part of the process for hydrogen generation are expected those breakthroughs. Thank you.
Mhm. Okay, thank you very much, Christian. Yeah, actually, I didn't mention that, but we have another tool that you may find interested if you are interested in terms of innovation, which is our Clean Energy Technology Guide. I will be happy to share the link afterwards. And there we track progress on technology development for more than 800 technologies. So there's much more than hydrogen if you're interested in other technologies. In terms of, particularly on the hydrogen production side, this is where we have seen more development, more technology development. So it's where we have more technologies fully developed, already commercial and also in operation. No? In terms of, but where we are seeing some things that are definitely going to happen in the short term, on one side is on the production of hydrogen from fossil fuels with CCUS. Today, we have already some plants operating with production from fossil fuels and CCUS, but only capturing 60%, around 60% of the CO2 produced in these facilities. The other 40% is still emitted. But we have now some technologies that are working on or that are aiming to capture 90% plus. Some of them are even claiming 98% of the CO2 produced within those processes. And we are aware of two large industrial projects, two or three, I think, in the US and Canada, which are expected to start operating in the next couple of years and demonstrating those high capture technologies. That's one side. On the other side, on the electrolysis technologies, apart from the fact that we are going to move beyond the gigawatt scale soon, something that we are seeing is a lot of developments, and we expect this to happen even at larger scale in the coupling directly with renewables. So not electrolyzers that are connected to the grid, but that are operating with variable renewables. No, and we have seen a large plant for methanol production, for example, starting to operate in Europe now, and we are seeing many others in China. This is quite revolutionary because Traditional electrolyzers have been operating on a constant base load and now on a constant electric input. And now we are seeing these technologies to start operating on a more flexible way. And finally, something that we expect in the very short term is also the type of electrolyzers that we are using. No, alkaline and PEM electrolyzers are very mature and already commercial, but we are seeing now that solid oxide electrolyzers are also reaching commercialization at industrial scale. And finally, at the very beginning of the presentation, I mentioned that there is also this opportunity of producing hydrogen or extracting hydrogen from underground, same as we are extracting today oil and gas. This is a very niche opportunity. It's still very uncertain. There is still a lot of technology development to be done, but we have seen a lot of interest on this and a lot of stakeholders moving to try to understand a bit better the underground chemistry and the underground geology to explore that possibility. So I think I will flag those 4 points as the areas in which we expect more technology development or more important breakthroughs on the supply or the production side in the near term.
Thank you, sir. Very clear.
Sorry, it's Mohammed here from TBS.
We have a question from Mohammed.
Sure. Yeah, it was, I guess, a question, more of a comment as well. So I think in South Africa, so I'm from DBSA. In South Africa, I think there's been obviously a lot of interest in our context to support a green hydrogen economy. So this includes, plans to create hydrogen hubs, also production of green hydrogen and ammonia. I think that has started already in the Eastern Cape region of South Africa. But I think one aspect was to look at applications to decarbonize your hard to abate industries, especially your steel, which you've mentioned, and I think in South Africa's context, the cement industry. So I was quite interested to hear some of the challenges, or at least what I've heard, the slow uptake, I guess, in the steel sector because of infrastructure challenges. So I just wanted to just to get a sense if do you believe that would be overcome? Because I think there are expectations that those are the industries we would want to target, especially in Southern Africa or South Africa. So we are looking at blended finance kind of facilities. I think there was a launch of a hydrogen facility or fund where you're looking at different funders coming on board to support the scale up of green hydrogen initiatives. I think one challenge we have faced, I guess, is in terms of mobilizing, for example, climate finance. If you're going to produce green hydrogen and there isn't a big market for local applications, especially in the context of countries like Namibia, it becomes challenging to source concessional finance, for these type of projects from climate sources. So maybe just to hear your thoughts on that as well. Where the climate finance, can also be used based on some of these, constraints where you don't have a huge local market. Thanks.
Okay, thank you very much. So in terms of the barriers, let me start from the barriers and how the situation. Most of the advancement that we are seeing specifically on the shipping sector, in the steel sector, is coming from Europe. So that is where the biggest project for the use of low emissions hydrogen in steel production is already happening. And it's a greenfield project that is starting completely from zero. The challenges that we are seeing are more for brownfield projects that are today already using DRI with natural gas and are aiming to switch to hydrogen, or new DRI projects from established players. And the reason for this is that although the impact on the final cost of the steel is significant, but it's not as much more expensive as is the case of low emissions hydrogen versus conventional hydrogen. This impact on the cost impacts as well the margins on the steel manufacturers. And we're speaking about a sector that has to compete globally and that operates with very thin margins. So any little impacts on the margin practically brings down the project. No? And then in terms of the infrastructure challenges, this is basically because the concept that these European steel makers are having for the use of hydrogen in their facilities is centralized production that can be distributed through pipelines to those steel facilities more than producing the hydrogen inside the facility, the steel facility, no? And this, of course, requires the creation, particularly of transmission pipelines, and there has been delays on the creation of these transition pipelines. Some of these projects were expecting to operate before 2030, and we are not expecting to see a lot of those transmission pipelines available before 2030. So that was one of the reasons on how or why the tenders were delayed. Then, in terms of opportunities, I think in an area in which we have recommended governments to cooperate with the private sector is in this idea of the creation of lead markets. And this is because we have lead markets for end-use products. So this is not about hydrogen, this is not about steel, this is about the final product that is produced within a much more complex value chain, no? And in the case of steel, we can pick the example of electric vehicles. What we have seen is that using low emissions steel that has been produced with low emissions hydrogen in the production of an electric vehicle increases the cost of the electric vehicle only 1%. So this is way lower than the 40% impact that the low emissions steel suffers when it's using low emissions hydrogen, which is 2-3 times more expensive than unabated hydrogen. So I think this is an area in which there could be opportunities to cooperate, because this can unlock demands for some premium users that are willing to have those small premiums on the end products. And this is probably very likely to happen in regions like Europe, where you have a larger number of potential premium users that are willing to absorb that product and that premium, because of SDG goals, for example. So I think that in terms of having opportunities to unlock this investment or support this investment on emerging economies, we think that focusing on looking for potential of these premium off-takers for these lead markets in markets like in Europe could help on reducing the need of this finance to cover that cost gap. So I think it's a matter of combining where there can be these end users that are willing to adopt these products and study which is the potential advantage that some of these emerging economies could have to develop those projects, particularly on this sector like steel, which is that one of the sectors that we think that has more potential